Welcome to the deep dive. Today we're tackling a really potent phrase in crypto, fair launch.
Mm-hmm.
It's supposed to be about equality, grassroots community. But, well, the sources we looked at paint a darker picture. They call it the broken promise of crypto.
That's right. And that's really the mission for us today, and for you listening. We're analyzing an article that traces how fair launch, that whole concept has changed.
Or been watered down.
Exactly, diluted.
Yeah.
From Bitcoin's, let's say, philosophical ideal, all the way to modern pre-sales. We need to figure out what true fairness would even look like.
Because when you hear fair launch, you picture this, like, perfect scenario, right? A real community effort.
Totally. No special deals for insiders. Everyone gets in on the ground floor. No hidden advantages. No team getting a huge stash up front. That's the dream.
Yeah, the dream.
But the article's point is harsh. It argues that now, in 2025, it's basically just marketing speak. Yeah. Less a principle and more a marketing slogan, I think was the exact phrase. The original values equality, making sure users and builders are on the same page, they've been twisted to fit how tokens get handed out now.
Okay, let's unpack this then. We need to trace how this idea got, well, corrupted. Let's start at the beginning, with the one everyone points to, Bitcoin.
Right, Bitcoin, often called the original fair launch. And for good reasons, you know. No VC money, no foundation holding tokens, no pre-sale.
Just open source code anyone could start mining. Sounds fair.
That's the story, the mythology. But here's where the article says, hang on, let's look closer.
Oh, what do they find?
Well, for the first year or so, Satoshi Nakamoto, or whoever that was, plus maybe a few others, they mined almost everything.
Really? Like how much?
Some estimates put their control of the network hash rate and thus the initial coin supplied at something like 70%, maybe even more.
70%. That sounds quite concentrated.
It's huge. And the article basically calls this early accumulation, which happened before anyone was even talking about a crypto market, a functional pre-mine.
A pre-mine. But Bitcoin's whole thing is no free mine.
Exactly. It kind of contradicts the clean image. You had a massive imbalance right from the start.
So, how is that possibly fair?
Yeah.
And why does everyone still hold it up as the gold standard?
Well, that's the crucial question, isn't it? The analysis points to one key reason it worked out, or at least didn't implode.
Which is?
Satoshi never spent those coins. They just sat there. So you didn't get this massive dump from the founder, flooding the market, crashing the price, and making everyone else feel cheated. Because that wealth stayed locked away, the network had time to actually decentralize more naturally.
So it was fair by accident? Or by inaction, maybe?
Fair by abstinence, I think, is a good way to put it. Not necessarily by its initial design structure if you look purely at that early concentration.
Okay, but even setting aside Satoshi's coins, the article argues Bitcoin's own economics undermined its original goal. Becoming peer-to-peer electronic cash.
Yeah, that vision sort of faded, didn't it? It shifted the fixed supply, the mining incentives. It pushed Bitcoin towards becoming an investment, digital gold.
Right.
And that built-in scarcity, well, it guaranteed a kind of wealth asymmetry over time. If you got in late, you simply couldn't get the same stake as the early miners, no matter how much computing power you threw at it later.
So inequality was baked in from the start,
yeah,
economically speaking.
Pretty much. And then you have the halving mechanism,
which cuts the miner reward every 4 years.
Exactly. And the article argues this just doubles down on the inequality across time.
How so?
Well, the idea is that network transaction fees will eventually pay for security, right? But the halving itself means that the reward for mining a block keeps dropping. So the system structurally ensures that miners contributing the same work today get way less reward than miners contributing that same work, say, 8 or 12 years ago.
Yeah.
It's inherently unequal across time.
Okay, so Bitcoin, the original, but maybe not perfectly fair, especially over time, it kind of relied on Satoshi behaving well.
Sort of, yeah.
So if that was the first attempt, what happened next? Fast forward to, 2020, DeFi summer, fair launch became a buzzword again.
Oh, absolutely. It was everywhere. You had projects like Yearn Finance saying, hey, we did a fair launch. Anyone can farm liquidity.
Right. I remember that. But what did fair mean then? Was it the same as Bitcoin's ideal?
Not really. It got diluted pretty fast. In that era, fairness often just meant we didn't do an ICO like back in 2017.
So it was more about not doing something old rather than achieving something new and truly fair.
Kind of, yeah. It was almost a reaction. But instead of a truly level playing field, it created a new kind of insider, the liquidity provider.
The LP. And the article digs into whether providing liquidity was really something anyone could do, right?
Yeah, it pushes back hard on that idea.
Yeah.
It argues that providing liquidity wasn't some simple, accessible thing. It
Right.
calls it a highly financialized business product. You needed serious capital. You needed to understand complex stuff like impermanent loss, manage gas fees. It wasn't really for the average person.
More for whales and sophisticated traders, maybe bots even.
That's the implication. Capital aggregators, automated systems, they had the edge.
And these fair launches, they weren't very stable, were they? I remember the article mentioning vampire attacks.
Exactly. If something is truly fair and everyone's aligned, it should be strong, right? Hard to attack.
Mm-hmm.
But what happened? SushiSwap immediately vampire attacked Uniswap by offering better rewards, essentially draining its liquidity.
Right, sucking the life out of it.
And then PancakeSwap basically cloned SushiSwap for the Binance chain. It was just fork after fork.
And the insiders or the quick movers in each new fork got rewarded again.
Repeatedly. It was this rapid cycle. The article makes a great point. This constant forking showed the model wasn't really fair or defensible. If the community keeps fracturing, the original promise must have been weak.
Yeah, that lack of durability is telling. If it was truly fair, why jump ship?
Because the fairness was superficial. It only held until the next shiny thing came along promising a slightly better deal for a new group of early birds. And this whole experience, this dilution, it paved the way for what we see mostly today.
Okay, so Bitcoin's model had issues. The DeFi model was kind of flimsy. Which brings us to now. The modern standard seems to be the pre-sale.
Yeah, the pre-sale or private sale model. And to get why this is the standard, you really have to look back at Ethereum's launch in 2015.
The original ICO?
Right. Controversial maybe, but it set the pattern. They raised, what, $18 million? And sold 72 million ETH before the network even launched.
Wow, 72 million ETH. That's a lot, even now.
It was more than half the supply that's currently circulating. That massive upfront allocation to buyers, that became the template.
And we see that template repeated constantly now with big layer ones and other projects, Solana, Aptos, Sui. They all raised huge sums.
Hundreds of millions, yeah. And allocated big chunks, sometimes 30, 40, 50% or more to VCs, the team, foundations, other insiders.
And this is where the article introduces that concept of delayed inflation. Right?
Exactly, delayed inflation. Think about it. These huge chunks of tokens given to insiders, they don't hit the market immediately after the TGE, the token generation event.
No, they're locked up. Vesting schedules, cliffs.
Right. Industry jargon for you get your cheap tokens later. So this massive supply overhang sits there off the market for months or years.
Which keeps the circulating supply looking low at first, helping the price maybe.
That's the theory. Artificially low supply early on, but then drip by drip, or sometimes in huge chunks when cliffs unlock, that insider supply starts hitting the market.
And the market has to absorb it. Which sounds a lot like inflation.
But it's inflation where the proceeds already went to the early backers. The article argues that when you buy the token on the open market later, you're not really investing in the network's growth so much as you are providing the exit liquidity for those early VCs and founders.
Wow, okay. That's a pretty cynical take, but it makes structural sense. You're buying them out.
That's the core argument. It reframes the whole thing.
And because this is so common now, the idea of fair launch has been warped again. Now it's just about how much insiders get.
Yeah, it's become a threshold game. The article points out that the industry seems to have settled on, like, if the team and investors get maybe 5% or less, that's considered fair enough.
Just 5% still seems like preferential treatment compared to the ideal.
Exactly. The principle of no preferential treatment is broken, whether it's 5% or 35%. The moment you bake in insider privilege at the network's core, the promise of equality is gone.
Okay, so we've seen the ideal, the imperfect original, the diluted DeFi version, and the compromised modern version. Where does that leave us? The article tries to define what a truly fair launch would actually look like, right? Based on value alignment.
Yes, it proposes a kind of ultimate test, a definition based on durability and trust.
What is it?
It argues that a true fair launch happens when the smallest unit of contribution to the network is rewarded equally and critically, regardless of whether you contributed that unit on day one or 10 years down the line.
Okay, smallest unit of contribution.
Yeah.
That sounds a bit abstract. Can you give examples?
Sure. Think about the fundamental work the protocol needs. For Bitcoin, that unit is mining a valid block.
Okay.
For some potential identity networks, it might be providing a verified human identity. For decentralized storage or computing, maybe it's contributing a certain amount of bandwidth or processing power.
Ah, I see. The basic building block of work.
Exactly. And the test is, Does the network reward everyone who provides that same unit of work with the same amount of network value forever? No special treatment based on who you are or when you showed up.
That is a very high bar. Almost seems impossible compared to what we see today.
It's incredibly high.
So, if you're listening and trying to evaluate a project based on this ideal, what are the key things the article says to look for? What are the criteria?
It boils it down to three main questions, really. First, are equal contributions actually rewarded equally across time? Like we discussed with Bitcoin's halving, the answer there is often no.
Right, the time inequality. What's the second?
Second, and this is the really radical one, are insider, team, or investor allocations at the network layer absolutely zero?
Zero. Wait, not just low, like 5%, but actually zero.
Zero. That's the standard proposed for true fairness at the base protocol level.
How would anything get built then? If the founders and the people funding it get literally nothing from the initial token supply. That seems counterintuitive.
It does, compared to how things work now. But that leads directly to the third criterion, which sort of answers that.
Okay, what's the third?
Is the network's ongoing inflation, because there probably needs to be some inflation to reward contribution, is it inclusive and totally on-chain, meaning everyone earns it the same way, it's auditable, and crucially, there's no hidden off-chain overhang from vesting schedules or future unlocks promised to insiders?
So if founders want to earn tokens, they have to participate, like everyone else. Mine or stake or provide that smallest unit of contribution.
Precisely. They have to eat their own dog food, so to speak. They use the network and get rewarded by the protocol like any other user.
This implies something really important then. If founders can't just allocate tokens to themselves, the network has to provide real value, real utility, right? It can't just rely on token price going up.
That's the utility imperative the article stresses. A truly fair protocol has to be useful on its own, regardless of token speculation.
And how do the builders profit?
They build on top. They create services, businesses, applications that leverage the fair base layer. Their profit comes from the ecosystem they enable, not from privileged access to the core network tokens.
So you separate the protocol layer from the business layer.
Exactly. When the core team's survival depends on the token price constantly rising to fund operations through their vested tokens, the incentives get skewed away from fairness.
Okay. Summing up the consequences of not doing this. The current system, with unlocks, schedules, vesting, pre-sales, the article argues it basically serves the insiders' balance sheets.
Right, not the long-term health or fairness of the community.
And it creates instability.
Critically, yes. A network that gives insiders a special deal is always vulnerable. Someone can just copy the code, remove the insider allocation, launch it again, and say, look, this is the truly fair version.
And potentially pull the community over.
It happens all the time. The article's core assertion is really powerful here. That absolute fairness, that zero insider privilege model, is the ultimate defense. It's the strongest foundation for a durable crypto network.
Because if the protocol is truly fair and the product itself is valuable,
there's nothing left to fork against. Why would you leave if the system treats everyone perfectly equally based on their contribution?
So fair launch isn't just a nice idea. It's potentially the essential social contract for crypto.
That's a great way to put it. It's the commitment.
Oh.
We treat everyone the same no matter when you get here. That promise, if truly kept, is what builds lasting trust and network effect.
Okay, that leaves us with a really interesting thought to chew on for you listening. If absolute fairness is the ultimate defense, and we agree that just having capital shouldn't give you special network privileges, what other kinds of contributions beyond just money or mining power would a truly fair network recognize as its smallest unit of value? How do you reward genuine, maybe non-financial, human effort equally over time?
That's the million-dollar question, isn't it? Or maybe the billion Satoshi question. Solving that is perhaps the next great challenge for builders aiming for real, lasting fairness.